Good afternoon, everybody. Welcome back to another pre COP29 webinar um, organized by Spectorico. We are joined again by a lot of audience who would be joining us from the US markets as well, because this particular webinar is focused on looking at the SEC climate disclosures set up in the USA market. My name is Noorulain, and I'm the founder of Are You Thinking Green? And we are going to have a discussion looking at what the current structure and the global policies entail for us, specifically in the US Securities and Exchange Commission, what they have set up, what are the rules, and what are the scopes of these? Where are the governance mechanisms looking at mitigating climate change? What does the climate risk management look like? And just also looking at an overall view in which we look at these particular rules and regulations in terms of other structures and other governance frameworks that are out there. So I'm joined by the founder and partner of Spectorico, Sajid Aslam. Sajid, welcome on this particular session today. Uh, just one final thing before we dive into the discussion, that we're live on LinkedIn. So feel free to ask any questions that we have throughout the course of the session, and we will ensure that we answer them for you. If there are any clarifications that you want to have from this particular webinar, or if there are any further queries, then if you're watching a recording as well, feel free to get in touch with us, and we'll ensure that the team gets across your questions to us. So, looking at the USA market, Sachit, in our last webinar a couple of days ago, we had looked at just an overall the green financial instruments. We had looked at different global economies, and we had a lot of case studies and a lot of successful um, business that you had spoken about from the European market. We do understand as it stands that in terms of sustainability reporting, the European market sets the tone. They occupy the largest share as well in terms of meeting the disclosure requirements because it's mandated. But now looking at US, which occupies 15% of this particular market, how important are these disclosures? And I know you have a presentation, we can take that up as well. And just go through the process of what the disclosures entail. What is the scope of it? Why are investors really interested in looking at these particular disclosures? Over to you.
Thank you, Noor, and very good afternoon to people who have joined us from US, and good evening from for UK, and I think it's a midnight in most of the part in Asia as we speak today. Uh, I think what I would suggest definitely we go with the presentation, but I think the bigger question which we are addressing here is more around why these disclosures are important. So why now, and is there any option, because there's still a lot of thought process going on in a different part of the world, that it's a nice to have thing, it's okay to have it, if we don't have it still it's okay. I think that's the bigger conversation, what's driving everything. So I think we will go through the presentation, and then we will come to the very fundamental question, whether there is an option to delay it further, and what would be the implication for the companies who are not going to follow through that voluntary or through the mandatory regulation, and how it will impact specifically their access to capital going forward. So just to go back to again a quick introduction, we are Spectrico. Spectrico is a global sustainability technology advisory and implementation company. We support organizations to automate their sustainability reporting in multiple jurisdictions and a multiple standards, and that take care of the entire ESG journey as well as the project tracking, the transition plan, the impact of transition plan on the target achievement, and all the forecasting and alerts based on the data which we collect, as well as the data which we use for benchmarking that where the market is going. So I think the key area is that whenever you are going through that journey, there's a lot of data and data management which is required, and then there's a lot of benchmarking which is required from time to time. You cannot use a benchmark which for the current year in the next 3-4 years, because the entire market is evolving. So before we get into the SEC specific regulations, let's have a look at what's happening in US in terms of regulatory regime. So if we pick up, there are significant large asset management companies who have already announced their ESG plan, and specifically not only the ESG plan, but how they are incorporating ESG in their investment decision. So if you look at just these top seven, eight asset managers or asset management companies, we are talking about over $20 trillion, which they are committing that they are going to use in the investment or for the companies or for the opportunities where the investment can really become risk free from a climate side, or a climate risk is properly managed or disclosed. So the key message right now, the driver for the regulations are these asset managers who have understood the climate risk, whether it's physical or position, and they want to make sure whatever they are investing in the right companies who have managed their ESG risk and particularly the climate risk. And in response to those demands, what we have seen, California right now came up with their Senate Bill 253 and then 261 and 219 as well recently, which is going to be implemented in the next 2 years. And that's impacting the climate disclosure, particularly the organization who are in California. Now we look at the SEC side. So SEC has came up with the regulation over the 10 years, that regulations how they were evolved. And in 2024 March, it was enacted or made mandatory or adopted, and that went under the judicial review as we speak today. But still, the implementation has got a timelines of December 2025. So we still believe that given the demand coming from the from the investor, these regulations are going to be adopted, or a part of it will be adopted voluntarily by the organization to qualify for the investment or to access the capital, and particularly the green capital. At the same time, we are also seeing there is a ESG fund disclosure proposal is already there as well. So that means the organizations like the asset management and the financial institutions, they have to disclose as well going forward. Specifically, one, they have to make certain disclosure in a climate disclosure rules, but secondly, they are going to be specific rules for the ESG funds, that how they are managing their criteria in selecting the investment. And what does it mean? If these regulations are there, so it's going to change how we manage the energy, how we look at how we are living, how we are going to manage the marine life, how the agriculture will be impacted, and uh, how the industry will be impacted as well. So all those things, the way we know today, are supposed to transition, because if the businesses are going to track that, that means those changes in their way of working is important. As soon as they will track, they have to improve as well. And for the improvement purposes, that means there has to be a proper transition plans, and those transition plans need to be reported at the same time. So the way we see life today, the way we are living, the way the agriculture is happening, the way we access energy, the way we look at the marine life, the way we look at the industry, it's all going to transition in the next 5 to 10 years for the good purposes. So it will be becoming more climate resilient. It will be taking care of the climate risk mitigation as well as the climate change adaptation, and that will be, again, the measurement is the first thing, and that's why regulators are coming up to create that visibility, what needs to change and how we are progressing. So let's talk specifically on a SEC climate disclosure rules, which is technically called the enhancement and standardization of climate related disclosure for investors. So the number one thing, it's very specifically targeted for the need of investors, so it can help them to make decision for their investment. And if you look at the history of it, so it's initially started in 2010 and finally adopted in 2024, although it's temporarily stayed and pending for the judicial review. But the expectation is that we will see one way or other these regulations being adopted or these rules being adopted by the major organization, so they can continue access the capital, because that's one of the thing which is most important right now for expansion or any climate related risk they are supposed to manage, not because the regulator are asking it, because those are the very genuine physical and transitional risks which sometimes become existence challenge for the existence of the business itself. So what are the key disclosures here we are talking about? So if you look at the overall disclosure requirement, it's not very complicated. It's very much aligned with TCFD, and a lot of organizations were previously also practicing that. It's just that it's now becoming mandatory, and that's being mandated by the regulator. So we are talking about the material climate related risk. So that's something which we need to disclose. Every business may have a very different way to look at the climate related risk. The governance and oversight, how we are managing that risk, what is the governance process at a board level, at a management level, to manage the climate related risk. And then the process, how that process is being implemented, which can identify those risks and help mitigate those risks at the same time. At this stage, SEC is only talking about scope 1 and scope 2 GHG emission. We do anticipate and expect that scope 3 will be a part of it, like in California. They have already mandated and announced the date that by when the scope 3 should be tracked and reported as well. So we will see that kind of evolution coming from SEC going forward. And then the other part is the financial statement impact. So how the revenue or a balance sheet item or a P&L item is being impacted at a line item level or at an overall risk level, that how these financial statements are impacted with that climate risk, how the assumptions were taken and how the estimates were accounted for in the financial statement. So assumptions and estimation which have impacted any line item of the financial statement, that need to be disclosed as well. And then what are the material climate targets and goals? So if we know where we are, what's next, where we are going, and how we are running a scenario analysis. Scenario analysis is significantly linked that whatever we are trying to do, whether we will achieve the target as an individual company. And this scenario, if we look at the national level, normally how we look at the global or national level, how we are contributing towards keeping the overall temperature less than 1.5 degrees centigrade compared to the last industrial level of 1850. How we can really control that it should not go beyond 1.5 to 2 now. That's what normally the reference point is. And if there is any carbon offset or renewable energy certificate, those also need to be disclosed. And if there is any capitalization around it, so that needs to be disclosed as well. And for comparison purposes, it's encouraged that the historical data on emission only right now as we speak should be displayed so that we can compare the year on year progress. So if you look at that broader category, there are 9 items which need to be disclosed. Interesting one is a scenario analysis, that how we are really confident that we are going to achieve our target. So that's require a certain, either the technology has to do it, or then otherwise you need a certain expertise to really reflect that in your disclosure. So how, where these rules are applied, like how, which organization need to adopt that as we speak today? So if you look at the broader category, there are other categories as well, and I'll share with you. So large accelerated filer, that means somebody who has got overall market cap of 700 million or plus, and public float, what we normally talk. So they have to report it in the financial statement of 2025. That's been the first disclosure which we will be seeing based on these regulation by these organizations, would be in 2026. But if we are preparing the financial statement of 2025, that's mean for comparison purposes, we need the data for 2024. So that's mean the adoption of that regulation has to start now. So we start collecting data and then start comparing data and bring a reasonable disclosures in 2026 when these regulations will be enforced. And if you look at the accelerated filer, not the large one, but the accelerated filer, then it starts for the financial statement year 2026. That means the first disclosure we will see that in 2027. But then the 2025 is the right timing when these type of organization have to start collecting and recording the data and start working towards that disclosure. So when they are when these rules are enforced to them and they have to really generate those reports, they have reasonable quality of data available and they have gone through that learning curve. And just a quick view on that, what the large organization, large accelerated mean that their public float is 700 million plus, and then if you look at the accelerated one, it's 750 to 75 million to 700 million float with the annual revenue greater than 100 million. Even the smaller companies also have to report that way if they have got a 250 million less public float and less than 100 million as a revenue, and then emerging growth companies, and then there's a foreign private issuers as well. So all these organizations have got a certain disclosure requirement at a different timing, starting from 25 to 28. The reports have to supposed to come out. So reports will be coming in 26 to 28. So some adoption is happening in 25, 26, 27, and 27 is the latest one in terms of the financial statements. So what we need to disclose. So there are certain examples that, for example, from a climate risk perspective, if there is a severe weather events and natural condition, and any line item which has got an impact more than 1%, that line item needs to be disclosed, or 100,000 minimum in term of the P&L item, or $500,000 in term of the balance sheet item. And then there is a material amount for the carbon offset that needs to be disclosed as well. And then the last item, if you look quickly, so impact of the climate related factors on the material accounting estimates. So how the accruals or estimate or depreciation, if we talk about, or amortization, how these are going to change, how the value of the assets which we are carrying on the balance sheet are going to change based on the underlying climate risk. So those assumptions and estimation both need to be disclosed as well. And if once we come to the GHG emission side, so right now the requirement is the emission 1 and emission 2, and these emissions need to be reported in terms of the CO2 equivalent. So there are 6 other gases as well, and we have to report that in tons of CO2 equivalents, the methodology, the calculation protocol, emission factor which we have used, what are the material assumption, and the data quality processes. So once we are reporting the emission at a scope 1 or 2, so their underlying assumptions, calculations, methodologies, or process, all those need to be disclosed and discussed in the report side. And if we come to the governance and risk, so again, the board oversight, how the board processes are working, how they are identifying the climate risk, how they are mitigating that, how they are providing oversight. Similarly, from a management leadership perspective, if we are talking about the CXOs, CEOs, so how those people and the management is looking after implementing the certain strategies which can help for the climate change mitigation, adaptation, and resilience actions for the organization to reduce the climate risk for that specific business. And then there comes the assurance requirement, particularly large accelerated organizations. They have to go with the limited assurance by 2029 and overall reasonable assurance by 2023. So it's required two things. Number one, the organization has to get ready for assurance, and the assurance provider at the same time have to acquire that knowledge and talent and build that kind of capacity so they can conduct those kind of audits at the same time. So SEC as well as California regulations both are coming up with the concept of assurance. So that means both sides, the businesses themselves as well as the auditors, they have to build that kind of capacity. And now let's have a quick look at what does it mean, what's happening in the rest of the world as well, and how SEC rules compare to IFRS or EU CSRD, and there are other SFDR as well if we're talking about specifically for financial institutions. And then particularly in EU, there is a further due diligence one which is called the CSDDD. So If you look at the issuer side, so SEC is the issuer in US as we speak, and IFRS is for the S1, S2 in terms of the two standards which they have already introduced. And in EU, it's EFRAG, which is called the European Financial Reporting Advisory Group, which has issued the certain standards. Uh, who it will be applicable? So in US, it will be the US registered organization. In IFRS, it's a worldwide scope. So IFRS doesn't have a jurisdictional structure. It has got a standard which need to be adopted, and then any jurisdiction which adopted that, basically they issue a certain circular that this IFRS is being adopted by the country, and then all the reporting side, their local SEC and all that, they start using that as a one of a benchmark. So for IFRS S1, S2, specifically for sustainability reporting perspective, different jurisdictions, particularly in a Commonwealth, have started adopting IFRS S1, S2, or started preparing for the adoption. In case of EU, CSRD is a directive, it's implemented. So it's right now it's enforced there. It's enforced on a EU entities. They have deferred the implementation for the non-EU entities who have got operation in EU. So as a branch office there. So there is a certain exemption right now, but this is how the jurisdiction or adoption is working right now. From a scope perspective, SEC rules are very much focused on E, a little bit on G. G is a governance. IFRS is all environmental, social, and governance. Similarly, CSRD is all environmental, social, and governance. From a topic perspective, there is a single topic which is a climate related. Once we come to IFRS, it has got a financial materiality, it has got the climate related specific disclosure at the same time. And if you look at from a CSRD perspective, so it has got a standard which is called ESRS, which is European Sustainability Reporting Standard. So it has got two journal reporting standards, and they have got a topic standard as well, like environmental, social, and governance. And then there is a further industry level standards which are under play as well. Similarly, there is a GRI as one of a global reporting standard. It also coming up with the journal standard as well as for industry specific standards. And from an organization perspective, there is a certain category who should adopt that. So from a SEC perspective, we just discussed that. And then from a Europe perspective, it's all the entity which has got a regulatory scope, and most of the EU-based organizations, small and large, even some of the non-EU entities, they are the part of this scope. And interesting part is the concept of materiality, that what really we need to consider as a material topic. So SEC is still focusing on the single financial materiality. Anything which is impacting financially to the organization, that's a material item. Similarly, IFRS is also based on a financial materiality, where the Europe and ESRS as well as GRI both are using a double materiality impact. That means the financial impact on the organization and organizational impact on the climate, both sides of it. So that's a more comprehensive standard, but definitely from a capacity and implementation perspective, it has got its own challenges to navigate. From a scope of emission perspective, SEC is talking about 1 and 2, IFRS is 1, 2, and 3, and then Europe is also 1, 2, and 3. From a TCFD alignment perspective, all these standards are very much aligned to TCFD, and number of organizations which are going to be impacted. From a SEC perspective, it would be a little less than 10,000 organizations, where 14 to 1600 are the large accelerated filer, and then 3000 plus are the accelerated filer, and then the rest of the organizations are already there. And then IFRS is based on a local jurisdiction. But from a Europe perspective, there are more than 50,000 organizations which are impacted with these regulations, and now they are preparing and they have started reporting using the ESRS. Scenario analysis, again, that's practically in all three areas. Uh, the scenario analysis are important. SEC is just talking about the material topics where the scenario analysis is required. And then in case of IFRS or CSRD, it's required for the overall business to evaluate the resilience, not only the specific topic, but overall business strategy perspective. So compliance and penalties. So it's a regulation. So it's given that if we are not complying with that, the regulator is not going to be very happy, and there is a already provided the civil monetary penalties from for the breaches. So this is a one of a thing which we have to keep in mind. SEC regulations are coming with the compliance requirements. So it's not very simple that if the regulation is there and we choose not to comply, there will be certain penalties. And again, the example we have seen in Europe, where the SWIR penalties are already in play as we speak. Uh, just a one or two last slides, getting to the closure now. So, what is the right implementation roadmap if we are planning to start looking at the SEC regulation, and we would like to go on a climate disclosure rules, which I would suggest definitely we should. So, it's a very standard one: assess and evaluate, build that infrastructure, how you will collect data, where that data will be processed, how that data will be segregated, classified, and then develop the methodology for the calculation, for the risk management side of it, from a review process perspective, how we are going to bring the assurance and then manage the compliance by disclosing the information in the financial statement as we speak today. There is no specific requirement for altogether a very different report, but there is a certain financial reporting which requires the additional topics to be disclosed from the climate risk perspective. So not very difficult. Anybody who is planning to start that journey, there's a lot of hand holding and a lot of content and a lot of technology which is already available. Spectrico is one of them. And that's bring me to the end, and Noor is already there. So I hope that has given a broader understanding what does SEC rules mean and who is it going to impact, and how to implement that. So there are regulations, not very complicated right now for US. There are a lot of investors who are looking forward that whenever they are going to make their investment decision directly or indirectly, they are going to choose the organization who are ESG compliant or where the climate risk is already managed, and that is all backed by assured data set and information and disclosure.
Wonderful. Thank you so much, Sajeev. And I guess this puts a lot of it, I can call it a master class if you're looking at the SEC disclosures for the USA market. And I just had a couple of questions before we turn on to the questions, if the audience has any and if they would want to ask us any questions. But just in terms of looking at how the discussion has been panning out, and we were even discussing it at another gathering recently, that now it's really about going from neutrality to carbon negativity. In the US, we have seen that there have been so many natural disasters that have amounted to, if not more, then in terms of a couple of billions and billions of dollars of damages that have happened. We look through the hurricanes, and that for me would be like a proof point of why all of the effort needs to be put into place where organizations start looking at the climate impact that's taking place. In terms of what do you think in terms of analyzing the US market, what is it going to be for some of the early adopters in terms of attracting these funds, the untapped funds that are available, and how can organizations benefit from them?
I think in US there are organizations who started earlier in under different pretext, and they have started tracking or reporting some part of it. Specifically, if you look at the organization who have adopted TCFD initially, so some part of that regulation they are already complying from a risk management, from a scenario analysis, governance perspective. So they are already disclosing those areas, if not exactly in line with the regulation, but significantly in line with the regulation, number one. Number two, the investors are already pushing. Like if we talk about the BlackRock, it's like a universal investor. If they are coming up with a mandate, That's been every organization directly or indirectly going to be impacted one way or other to report something. And if they are unable to disclose their climate risk management strategies, that means they may not be able to attract or, in some cases, retain the investment which they have already got. So, I think access to capital is the one of the biggest incentive as well as the risk here. Once we look from a US market, so any early adopter will be someone who can attract the maximum investment from uh, from the investor side, because right now investors are looking for that kind of opportunities to build their portfolio or transition their portfolio, but there are not many organizations who can provide the auditable data or provide a disclosure which is in line with any global standard. So I'm sure any early adopter for SEC climate disclosure rules will get a benefit and manage to attract the investor. And the entire purpose of these disclosure is the investor, to make it easy for investor to understand the risk and make their decision. So early adopter is definitely going to benefit from the excess capital.
Wonderful. And then the list that you have shared is also, could be a potential starting point for where organizations can say that, okay, which investor would be the right fit for their particular organization as well. I picked up something from your presentation, Sajid, in which it was yet to be confirmed, but there was also a mention of the ESG fund disclosure. So that actually also comes in from the management commitment that we always talk about. So in terms of that ESG fund disclosures, what should be the right strategy for any um, leadership team who's deciding to go on this particular journey? How do they allocate funds? Is there a rule of thumb, and can we like link it up with profitability as well and the financial gains that the organizations would be looking at?
I think I'll answer that a little bit differently. So I think the world is following the European footsteps there, right? So how the Europe started? Europe started that there has to be a CSRD and SFDR. There are two regulations they came up with. SFDR was for the financial institution, how they will qualify a one financial instrument as a green or non-green. And when the SFDR came into, it was enforced there back in, I think, mid 2023, suddenly there was a 500 billion worth, 500 billion euro worth green bonds were out there, and they were downgraded just because they were not fulfilling the definition. So
Hmm.
that's a financial institution side. So and then the second is the CSRD, how the organization will report their ESG and the climate related stuff. So the investor or the financial institution can evaluate that data while making their decision, and while issuing a financial instrument to raise funds, they should be able to justify and disclose that this is my portfolio and this is how I have applied the criteria and this is the information organizations have provided. I use that information and this is where I'm going to invest. And that's why my instrument is green or my instrument is not green. Even in Europe, they have categorized in a dark green and a light green and a green. So there are different shades of the greens as well, which is
Hmm.
an interesting concept. So we are seeing the same footstep which the rest of the world is facing. So SEC regulations, those are more for the organizations to report everything. And now we are foreseeing that there will be additional regulation which are coming from for the financial institution. That, by the way, California has already enacted those, right? But but that's only for California that's a state level regulation. So SEC is also coming up. Anything when we claim that this is a ESG fund or it's a green financial instrument, so how that fund is satisfying itself that whatever the investment they are raising is going to be invested in a right kind of companies. So those companies have to start disclosing it, and the ESG funds need to disclose their criteria and ensuring that whatever the fund they are raising from the investor as a ESG fund, basically following a certain criteria, and those investments qualify based on a auditable data. So the key word is the auditable data and disclosure, because prior to 2022, there were a lot of voluntary disclosure. There was a lot of disclosure which was not as per standard, and it was not even required. But now, with the post 2022 and particularly in 23, with all the regulations coming into force in a different part of the world, the flow of money, and we are not talking US only, the money from Europe and from US to Europe or Europe to US, that money is particularly from the organization who have got our investors or asset managers who have got a commitment to ESG, will only flow using that kind of information which is quantifiable, verifiable, validated, assured, and based on a certain standard. It could be SEC regulation, it could be IFRS, it could be ESRS, it could be GRI, but there has to be a one standard where the organization can compare their ESG disclosure with others.
Yeah, Sajay, then absolutely. And I think we've been talking a lot about, this flow of money, and there's an ongoing debate. We discussed this before as well, that once the developing countries are setting up a standard, then there's obviously a flow of money coming in, and there's a trickle down effect to the developing countries as well to look up on that. And what I want to ask you, and this is more of a clarity in my head as well, that with a lot of discussions also happening around greenwashing, right? Organizations have been called out for, just putting their process, just making a commitment, putting a claim that we are very environmental friendly. But when we look through the whole process flow, when we look at the suppliers, when we look at them getting their raw material or their processes flow from, let's say, developing countries, um, is there also a business case in which there could be a mandate to stop the greenwashing that's taking place?
I think if you look at the US side, there are a lot of examples from Europe. I'll not bring that out, but let's look at the US side. Why a lot of people are reluctant to adopt these SEC regulations or start their journey now, or the people or organization who haven't adopted TCFD earlier, or there was a climate disclosure project before that. So a lot of organizations who who never adopted that, or who have adopted that and then they stop. And the biggest challenge is the availability of a talent to understand the data which they need to collect, and then calculations. And the challenge post 22 is that if those calculation and disclosures are not right, there is somebody watching. So whether it's a regulator, and where the regulations are not there, it's media. So even media is bringing it out. Even there is a political threat to the organization that I might be disclosing something which I'm doing good partially, but I try to bring it out that it's compliant. So word compliance is very different, rather than we are talking about doing something good. Greenwashing specifically, after the regulation, anything which doesn't qualify to with the definition of regulation, if they do not meet the benchmarking, any claim from the organization is greenwashing. There was a time when we used to say if you are using 25% recycled material, you are doing good and it's a green product. But now, green or greener is not good enough. It has to qualify the definition. So, if the definition says you cannot call a product green unless until it's using recycled material in terms of packaging, and all the ingredients they are being used are organic, if this is the definition, then this is the definition. You can't say that I'm better than others, so I'm a greener one. So that greener word is no more there. Either it's a green or it's not a green.
And Sujit, one most important stakeholder, I believe, that's in all of this is that the consumer has started to call out
Yep.
the companies and organizations with there's so many case studies, there's so many startups that I also have experienced in the very recent past, who are scaling up their products, and they have absolutely a consumer base that is so dedicated, that because they're claiming and they're saying that we are calculating every little carbon footprint that we are producing. So I'm just going to bring the questions in. But you mentioned something about a political threat as well. We're looking at the U.S. market as we speak. 4th November is really near. We're looking at how the political sphere sets the tone for all of the regulations, pretty much for the next 4 years. What do you feel, or what is the sense around the fact that is it going to sway? Are things gonna be aggressively implemented? Because a lot of the things right now, which I'd say that to be confirmed, or maybe the process is still somewhere on the yellow light and the green light has not yet been given. So, is the political stance going to change how the regulations are going to work, or do they pretty much, it's going to be ready, get set, go, and then the companies have to adopt?
Uh, I think if I see the investor sentiment, so a lot of people are in a wait and see mode for the last 2 months, and I'm sure for the next month. So this quarter specifically, we will see people would like to evaluate how who is get to the presidency and how it will act or react towards the climate war. Having said so, I think the threat which initially perceived with the Trump when he came earlier and basically discontinued the Paris Agreement, and then the Biden administration again invoked that clause, and they came to uh, they actually came back to the Paris Agreement. So I think by this time, the way the world is, it's very difficult to isolate yourself from the climate risk or a climate change responsibility. In fact, in the last 3 4 years, the term has changed from a climate change or a climate mitigation to a more just transition or equitable transition now. How the responsibility will be fixed. The level of investment came from China in a green project and the green technology. Similarly, the things which we are seeing in Middle East and Europe. US unfortunately historically has got the large industries left there which are very much fossil fuel driven. Oil itself is a very big industry. The material which they are importing or using right now, they have not changed towards the sustainable material yet to the level where the other organizations are. But at the same time, in the US, we are seeing a luxury negative carbon living at the same time, and people are responding to it. We are seeing the hospitality industry is going green, and there is a research showing that any hotel or accommodation which is claimed green and demonstrate that they are green, so they are charging 10 to 18% price premium. All the organization and airline industry as we speak today, and airline is a very big industry, so they have started disclosing that how much carbon emission a one flight will carry. So if I'm sitting in an economy class of a certain airline, so I know that this is the carbon emission I'm going to be responsible for that. So if they have started on that journey, it's very difficult to reverse that. Although there will be a political pressure, given the type of industry US is operating or a leading industry, they are the one who are a big emitter. But at the same time, we are seeing those organizations investing in a transition side. It's just a matter how ready they are, and if they make that kind of disclosure today, how the public will react. But the demand from the public is given that if the hospitality industry is able to charge 10 to 18% price premium just by demonstrating that they are green, and if the luxury living with the negative carbon or carbon neutral side, it's selling at a higher price, that's been customer and consumer and investor have started responding to it. So politically, whatever the change happens, I don't see that process is going to be reversed. The demand from investor and consumer and regulator is going to be there. Organizations and investors both become accountable how they are making their investment decision and how they are managing their operations, how green they are, how sustainable they are, and how they are managing the climate well.
Absolutely.
They are a
And
part of a problem or they are a part of solution. So that's a simple question there.
absolutely. And I think I'll also like to add, Sajid, that if we look at the post-COVID, if we look at the healthcare industry, that too is right up there. beauty industry, the consumer is super loyal to brands that are actually conforming to this, and we see we see a shift, and we see how the consumer is actually leading the show because business is happening. I'll quickly move to the questions because we have a few, and I saw Farouk's question. Farouk is asking, which is in related to the transition that you were speaking about, that it is a complex task, the SEC disclosure, but how do companies decide whether to invest in upskilling existing resources, or just hiring new ones, or just outsourcing the whole process? Mm, that's a good question. It's my
I,
favorite question.
yeah. So again, based on my experience historically, how the organization, specifically large organizations, they start with the outsourcing and managed services. Meanwhile, they start evaluating the upskilling of existing with the blend of some new resources. So I think historically we have seen that as a best strategy to, rather than hiring all the experts there, because that's require a very different kind of expertise, use a managed service or outsourcing or technology as a model, and then move towards the in-house capability side if it's required.
Yeah, absolutely. And I think there are so many open sourced products that are now available that can be white labeled as per organizational fit. The good thing in all of this is, Ajit, I don't know if you agree with this, that we have the basis to start off from. You have the standards to already give you a
Yes.
guidance to put you on the right track. And correct me if I'm wrong, that even for early adopters and for organizations that are on the brink, uh, you are not liable to follow the standard to the T, right? You could just
Yeah.
start off from somewhere, right? And just show progress towards that. And I think that brings me back to the point where you were talking about forecasting. There's actually some cushion and some stretch in terms of uh, telling the regulator, telling your investors that this is where you started off from, but then your efforts have actually, in 3 years' time, in 5 years' time, actually led you somewhere. And I do recall that, every time we look at any kind of like appreciation that is, or awards that are given to organizations, it's always not about short term gains, Sajid, and it's always about looking at the bigger picture and the long term gains as well. I'll just club this with another question that we have, that Mariam is asking, that what are some of the alignment with the regulatory and the investor expectations? So long term vision is an investor expectation, right?
So I think if let me start with the first one. So I think you rightly identified having a SEC regulation in US give a very good base to organization to start as a step one. Before that, the TCFD is there for a while. SEC regulation and the working and discussion is going on since last 15 years, right? So when we talk about the early adoption, we are talking about early adoption after the SEC regulations are adopted, like March 24. So I think the rules have already set the certain standard and a step 1 to step 10, how the step 1 to step 10, how the journey should work. So definitely there's no harm in starting today. And for some of the organization, which is 14, 1600 large organizations, either way, if the rules are enacted, when the judicial review will be over, which will be over soon, so they are bound to report their 2025 operations as a part of those disclosures. So we are 2 months away from that, right? So I think this is the right time to start working towards that, having your partners in place, start working on a capacity building, start working towards that. If there's any delay, it would be a year or so, right? But it's not anticipated. We are talking about 14, 15 years effort, and we are talking about the pressure from the entire world. And the rest of the world has already started their journey one way or other. So US cannot be the one which is left behind. So they will not be a part of the global economic system, or particularly the flow of the investment, and particularly the green investment. They will not be able to claim a fair share if they don't start their journey now and bringing out their star organization, which are green, which can again start attracting investment from around the world. The stock market in US always remained very liquid just because they managed to attract investment from the around the world. And to continue doing that, this information will be required by most of the European as well as now Middle Eastern. KSA is a very big investor there, so uh, they also require that kind of disclosure for their decision making. Even if the SEC regulation doesn't apply, or that doesn't the organization do not follow that, they still have to follow the disclosure one way or other. So this is where we stand in terms of interest of investor and ESG. So whether there is a conflict somewhere or not, so it depends who we are talking to. There's a lot of political debate in US specifically, and without naming that, one state has basically given a stay and a decision that the asset manager should not consider ESG as a part of a decision making, and they should look at the financial returns as the one of a primary criteria. But rest of the states have rejected that. California is the ideal example. They are talking about the climate action accountability side. So they are specifically using the word accountability there. So we are seeing that debate, but now we are seeing more convergence, and the issue is getting settled down rather than staying as an open-ended one. So people have taken the side in the past, but I think now they are finding the middle ground, that what is the important thing and why it's very important there as well.
Yeah, excellent. Yeah, I mean, I'm going to club two more questions. I think we've kind of addressed Saad's question, in which they're saying that many suppliers of textile to the US are based in countries where, carbon emissions are not monitored. And, what could be some of the ways in which they could implement better policies? We do have a case study in here, Sujit. That we've seen suppliers that are from developing countries, uh, giving their products across to US based organizations, huge textile manufacturers making in billions. What is the motivation, Sajid, and how do they stay relevant in the market?
I think that there are two things, and now we are very specifically talking about uh, cross-border carbon adjustment mechanism. So US has EU has already implemented a one system which is called CBAM, which is a carbon border adjustment mechanism. So anything which is crossing the border, either the importer or the exporter has to offset the carbon emission which is generated for the production or for the lifetime of that product, depend on the nature of the product, right? So that's mean either exporter will pay or importer will pay for that. So that will add in the price. So recently in a compliance market in Europe, it was somewhere like 75 to 88 euro per metric ton. So just add that as a part of the price. So that's the first thing. Second part is that whether that mechanism is available in other part of the world. So like I earlier said, that most of the world is following the footsteps of EU right at the moment, because from a regulatory prescriptive regulation perspective, they are a little bit ahead. US is significantly principle based regulation, so that's when they will pick up some of the principles, and they would also like to adjust that the carbon emission should not become a state responsibility just because they are importing something there, and that's what happened in the past. So the developed countries and the developing countries, the biggest shift which we have seen, the question which came, and that's a very big political debate, the consumer should pay for the carbon emission or the producer should pay for that. So what essentially mean, China should pay for the rest of the world consumption, or the consumption which happened in US and Europe, they should pay because they were the one who wanted that cheap product at a certain price and at a certain volume, and that consumerism actually led to a lot of this kind of emission side as well. So I think that's a good political philosophical conversation. But the first regulation which we have seen there, who is addressing that at right now, if not in past, so that's the CBAM in EU. Asia Pac is following the similar one, where they are also talking about, particularly in ASEAN region, they have already talked about that whenever you raise an invoice, you have to really bring out that how much carbon emissions are there. A lot of textile, the big brand, they have started asking their supplier to report on a certain format. They have provided them with the form that whatever the carbon emissions are there, and they have to provide the certificate that there is no child labor, there is no bribe, so they have complied with XYZ in terms of the ESG. But even the emissions, they are also asking, if you can't provide the measured one, give the estimated and calculated one. So right now for the scope 3, because that's what the scope 3 is all about, the suppliers related emissions. So right now there is no regulation which enforce that the scope 3 has to be properly measured. So there is a certain estimate which are allowed there. So people have started talking about it. So that means a supplier, if I am selling something and I am reporting lower emission, there's a certain assurance process which these big brands are using, and there's another supplier who is reporting for the similar quantity higher emission. Suddenly the supplier with the low emission become more attractive, right? Because somebody has to offset uh, financially, or at least in terms of the disclosure, or in terms of on the moral ground that their uh, 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 purchases are generating more emissions. So there is a certain internal mechanism which they would like to reduce it. So there is a supplier trainings coming up. There is a buyer-ment, there is a capacity building, there is a demand. So I think from a customer, once we talked about the US initially, it was all about the investor, but now we are talking about more customers, how they are really impacting the overall global supply chain in terms of the production capability, as well as low carbon production facilities are becoming more popular with the global suppliers.
I think absolutely, Sajid. And just to answer Saad's and Farooq's question herein as well. Look at the case studies. Look at I have a favorite one. Just look at it. Just look through the financial report, and you'd find why it is a win-win. Look at what Interloop has to do as a supplier from a developing country, supplying to the US big giants, and why does it make sense to them? So I think your answer would be hidden there. Just look at the accolades, just look at the way in which certain standards are being met, and there is a constant, you would say, effort. I'm not going to say struggle, but I'm going to say effort in terms of meeting these requirements, because then you need to, make more business, and it's making more sense to you as an organization that is climate friendly. Just looking at the time, and I'm seeing if I'm missing any questions, because there were a couple of overloops. We have touched based on the scope 3 emissions as well, so that's something that we can also address. Um, Final comments in terms of, Sajid, what does the future hold for US based regulations? And you're saying in another month's time, we're going to say which side are the regulation and the implementation going to start off. But what does the future hold for US SEC compliances and regulations for any organization, big or small?
I think I'm very confident that these regulations are going to stay, and the organization has to comply with that. And there's no bad thing. They are doing that either way internally. It's just they have to really come in a more structured way with the right kind of risk management strategy to ensure, and I'll use that word very carefully, to ensure they can access the capital or they can retain the capital. Because there are conversation among the large financial institutions that they will pull out their money if they are unable to understand the climate risk for that particular industry or particular organization. So that's mean the access to capital in form of equity, loan, bond, even the stock market. Right now, the biggest ESG scoring ranking companies all are in US, right? So that's when ESG is going to be there, and that's going to stay. So I foresee that the sustainability and ESG reporting is going to be a part of the regular financial reporting, and it will help investor and even the customer and regulator and the governments to understand that how the overall transitions plans are working, and how the private sector is mobilizing capital to really implement the climate mitigation, adaptation, and resilience strategy at least at their business level and the communities they are responsible for.
Absolutely. So, on that note, let us close today's webinar, the Transition Dialogue. These are part of a series of pre COP29 discussions. We are back in, I think, a day after tomorrow with another webinar. So, if you haven't yet, please sign up to the LinkedIn page so that you get the notifications. The recordings are available also on our social media pages. Feel free to go through them. If you have any more questions, there are contact details available of the team who would be happy to answer any kind of questions that you have with regards to the different insights and the webinars that we are doing. So, thank you so much, everybody, for joining us this afternoon. And I hope you have a great rest of the evening. Thank you. Take care. Bye bye.
Thank you, Noor. Bye bye.